The reason most people fail at investing has nothing to do with picking bad stocks or bad timing. It is about identity. Somewhere along the way, you accepted a version of yourself that says you are just not a finance person. You told yourself the market is too complicated, too risky, too much for someone like you. And the moment you believed that story, you handed your money to a system that was already designed to take it. You are not bad at investing. You are being manipulated into losing. Every single time you open your brokerage app and follow a tip, check a hot list, or buy what your advisor recommended on a Thursday afternoon call, there is a machine running in the background. That machine does. Here is what we are actually comparing today. On one side, you have the traditional commission-based brokerage model, the model that built Wall Street, that funds the fancy offices, the cable news appearances, the free research reports. On the other side, you have flat-fee investing platforms, the kind that charges you a fixed monthly cost and has zero financial reason to push any specific product on you. This is not a small distinction. This is the difference between a doctor who gets paid by the pharmaceutical company whose drug he prescribes and a doctor on a flat salary who just wants you healthy. Both call themselves advisors. One of them has a conflict of interest baked into every single recommendation they make. According to a 2015 White House Council of Economic Advisors report, conflicted investment advice costs Americans approximately $17 billion every single year. That number has not gone down. Now you might be thinking, okay, I knew brokers made commissions, that is not new. But here is what most people miss entirely. It is not just about commissions on trades. It is about the invisible architecture of what you never get told. Let's walk through exactly what happens when you invest through a traditional commission-based broker or a platform with payment for order flow built in. You sign up. The interface is clean, maybe even beautiful. There is a most popular stocks section, a trending tab, a list of analyst upgrades. You feel informed. You feel supported. On a Tuesday in March 2021, Robinhood users collectively bought GameStop at prices above $400 a share, partly because the app gamified the process. Green confetti fell when you made a trade. The app sent push notifications when stocks moved. None of that was accidental. You are now inside a machine engineered for engagement, not for your returns. Meanwhile, your full-service broker at a major firm is operating under what is called the suitability standard, not the fiduciary standard. Suitability means the investment only has to be suitable for someone in your general situation, not the best possible option for you specifically. That is a legal standard so low you could drive a commission truck through it, and they do, every day. The problem goes deeper than a single bad trade. It compounds, literally. A 2023 study published in the Journal of Financial Economics found that retail investors who rely on brokerage-generated research underperform the market by an average of 3.8% annually. Over 30 years, with a $50,000 initial investment, that gap does not cost you tens of thousands. It costs you over $180,000 in lost compounding. But here is the part nobody puts in the brochure. The broker does not lose when you lose. When you sell in a panic, they collect the spread. When you buy on a tip, they collect the commission or the payment for order flow. When you churn your portfolio trying to chase returns, they collect again. There is a term for this in the industry. It is called churning. And while illegal churning does get prosecuted, the legal version of the same behavior, nudging you toward more active. Now let's talk about what the other side actually looks like. Flat-fee brokers and fiduciary advisors operate on a fundamentally different incentive structure. You pay a flat monthly fee or a flat annual percentage of assets under management. That is it. There is no commission on which ETF you buy. There is no payment for order flow. There is no referral agreement with a fund family. When your only revenue comes from the client staying and being satisfied with long-term outcomes, your advice changes. Platforms like this exist right now. Vanguard Personal Advisor Services charges roughly 0.3% annually with no trading commissions. M1 Finance offers flat-fee premium tiers with automated rebalancing and no hidden markups on trades. Betterment charges 0.25% annually and is required by law to act as a fiduciary. None of these companies make more money when you trade more. That one structural fact changes every single recommendation you receive. When your advisor has no reason to push product A over product B, they stop pushing products and start building portfolios. The conversation changes. The outcomes change. The identity you have as an investor starts to change too. Let's put both paths side by side so you can see exactly what we are talking about in real numbers. Scenario: you invest $10,000 per year for 25 years, targeting a diversified index portfolio with 7% average annual return. Path A: commission-based broker with average all-in cost of 1.5% annually in fees, spreads, and underperformance drag. End balance after 25 years, approximately $432,000. Path B: flat fee fiduciary platform at 0.3% annually, same 7% gross return, same contributions. End balance after 25 years, approximately $567,000. That is a $135,000 difference. Not from picking better stocks, not from timing the market, just from who you paid and how they were compensated. Now here is the pattern interrupt. That $135,000 is not what the broker stole from you. That is what the incentive structure quietly redirected over 25 years without anyone doing anything overtly illegal. That is the system working exactly as designed for them. The question: here is the verdict, and it is not complicated. The commission-based model is not evil because individual brokers are evil. It is structurally misaligned with your financial success. That misalignment is baked into every interaction, every recommendation, every trending list, every push notification you receive. The flat fee fiduciary model is structurally aligned with your long-term outcome because that is the only way it gets paid. When you understand that, you stop asking which stock to buy and start asking who is advising you and how do they make money. That is the shift from being a retail investor who gets picked apart by the system to being someone who understands the game well enough to stop playing the rigged version. Remember that identity question from the start? You told yourself you were not a finance person, but the truth is, you have been doing finance every time you clicked buy. You just were not doing it on a level playing field. That changes today. Here is exactly what you do starting this week. Step 1. Audit your current brokerage. Go to your account settings and find the fee disclosure document. Look for any mention of payment for order flow, 12B1 fees, or revenue sharing agreements. If those words are there, you are in Option A territory. Step 2. Identify your broker's compensation model. Ask directly, are you a fiduciary at all times or only sometimes? That qualifier matters. Many brokers are fiduciaries during planning sessions but switch to suitability standard when executing trades. Step 3. Compare platforms. If you want to make the switch, I recommend starting with a flat fee platform that legally operates as a full-time fiduciary. One option worth looking at seriously is Fiona. They offer a flat monthly fee structure with zero trading commissions, full fiduciary status, and an interface that does not gamify your decisions with push notifications designed to trigger trades. The link is in the description with a breakdown of their exact fee schedule so you can compare it yourself. No confetti, no trending lists. Just your money, working on your timeline. Step 4. Automate your contributions. Set it monthly, set it, and forget it. Every extra trade you make on impulse is a transaction that someone else built a revenue model around. Boring investing is almost always better investing. The data is unambiguous on this. Before you go, here's what I need you to understand. The identity you built around being bad with money was not your fault. It was engineered. Every confusing interface, every jargon-heavy prospectus, every phone call from a broker who talked fast and used acronyms was part of a system that benefits when you feel confused and dependent. The moment you understand fee structures, the moment you ask who profits from this recommendation, you become a different kind of investor. That is the actual edge. Not a hot stock tip, not a secret indicator, just structural clarity about how money moves and who it moves toward. If this changed how you think about your brokerage account, share it with one person who needs to hear it. Hit subscribe if you want more breakdowns like this every week. And drop a comment below telling me what your current broker charges you in total annual fees. Most people genuinely do not know. Let's find out together. Disclaimer. This video is for educational purposes only. Nothing constitutes financial advice. Always consult a licensed financial advisor.